China raising bank reserve requirements for a second time this month. This in an attempt to cool down the world's hottest economy. Let's get reaction now over the phone from Hong Kong from Andy Shia, the former chief Asian economist at Morgan Stanley and someone who has been talking about bubble fears in the Chinese economy for some time now. Andy, thanks for your time this morning. Let's get your reaction to the move taken by China today.
Yeah, I think that the government is concerned about the property market. It looks like an asset bubble. There's excess liquidity in the system. The January loan growth was extraordinarily high. And also inflation is picking up pretty fast. So I think that the government feels like it has to do something. So it's taking these steps. I think these are really gentle moves, probably insufficient to stop the inflation from getting worse. So they have to raise the interest rate pretty soon.
Andy, as John alluded to, I mean, you've been talking about bubbles in China for a long time. Do you think the Chinese government is worried about bubbles? Is this the proof?
Yeah, I think that with the property market is at such a high valuation, rental yield like under 3%, price-income ratio in major cities 20 times or higher. So obviously, it's a very scary situation. So I think the government is concerned. So they're taking steps. The issue is that they're hoping for some sort of a softer landing, and I think that I don't know. Maybe it's possible, but I think that the government needs to raise interest rates soon. Otherwise, it may be too late.
Right. So, Andy, it sounds like you're saying that what they're doing today, or what they've done so far, is not enough to stem inflation. What do you think should be done? Give us an example of what they could be doing.
You know, interest rates are too low in relation to inflation or economic GDP growth rate. Demand deposit rate is about 0%, and long-term deposit rate is about 3%. And that's for an economy it's been growing at 8 to 10%. And inflation rate, the Statistics Bureau reported like 2% in January. And I think that number is considered not reliable. And the prices are going up really fast. And the inflation expectation is very high. So I think for savers, the incentives are really going down in terms of keeping money in the banks.
So
I think
interest rates, you say, Andy, should go higher. What about just taking further steps to increase these reserves again and again? We spoke to someone earlier from Standard Chartered who said they're probably going to do one move like this per month until the desired effect is not quick enough.
Well, the issue is that as long as you have excess liquidity, this sort of move doesn't work because it's on the margin. You have not shifted from excess liquidity to insufficient liquidity. You are just reducing excess liquidity. So I think that we are very far away from insufficient liquidity. Loan deposit ratio is 67%. So right now, with this move, the deposit reserve requirement is under 17%. So I think it's not going to really suck away all the excess liquidity. And at the same time, there's a lot of hot money flowing to China, and that hot money is chasing after this asset bubble. And unless that you deflate the asset bubble, the hot money will keep coming. So you raise the reserve requirements to suck out some liquidity, excess liquidity. More is coming in. So I don't think that's an effective solution. You have to raise interest rates to show that you are serious.
Andy, we thank you so much.
Yeah, Andy Shia, the former Asian economist for Morgan Stanley,
who's been talking about bubbles in China for over a year.
Long time.